Welcome to Illuminati Silver. We tell the truth about silver. Today is Sunday the 27th of June 2021 and we're looking at the equity markets and asking, are we due for a crash just yet? But first, just a brief shout out to two videos we produced yesterday. The latter one in the afternoon, no more financial support sooner rather than later, suggesting that central banks may actually cut back on many forms of monetary easing, and also governments may be considering that too, and we look at that in some depth. And also earlier in the day, our gold and silver weekly update. So let's now take a look at a Reuters article, which we comment on as we go through the article, suggesting that there may still be some mileage yet in our equity markets, but investors are certainly becoming quite nervous. So let's take a look. So let's take a look at this Reuters article dated yesterday, which was Saturday 26th of June. Headline, Wall Street week ahead as rally in US stocks rolls on, signs of caution grow. And we'll comment if appropriate during the course of this reading. The S&P 500 shook off concerns about a more hawkish Federal Reserve to post a record high this week. But activity in some areas of the market indicates concern over potential volatility ahead of key economic data and corporate profit reports. Now, as we mentioned in our weekly update yesterday, of course, this coming week, we have the jobs data from ADP, the weekly jobs update, and of course the non-farm payrolls on Wednesday, Thursday and Friday. Friday obviously being potentially the most impactful. We've also had, of course, Joe Biden, the US President, announcing the fact that his $1.2 trillion package for infrastructure spend is likely to be signed with a caveat, but nevertheless we all know ultimately that will be signed off. And so this has certainly helped buoy markets because, to a degree, it's even more monetary easing or more money going into the economy. US President Joe Biden's embrace of a $1.2 trillion infrastructure spending deal has helped buoy indexes to fresh records after worries that the Fed may unwind its easy money policies sooner than expected led to a brief swoon earlier this month. Would have helped if I read the article before I made the comment. The benchmark S&P 500 is up about 14% this year after hitting a fresh record in the past week, as did the tech-heavy Nasdaq. Now, underneath the hood, however, there are signs of caution. Short interest in the SPDR S&P 500 ETF Trust increased to its highest level this year since last week's Fed meeting, suggesting investors have been adding more downside protection, JP Morgan analysts said in a recent note. At the same time, gains this month have been more concentrated, as investors piled back into the big technology stocks that led markets higher last year and for most of the past decade. The benchmark S&P index, heavily weighted towards technology stocks, is up 1.8% this month. But the average S&P stock has lagged. The equal-weighted S&P 500 is up just 0.3% in June, which some investors view as a sign of waning confidence in the broader market. The market has maybe dodged a few scares, and as we look ahead to the second half, there are probably some more risks ahead than there were a few months ago, said James Reagan, Director of Wealth Management Research at D.A. Davidson. Investor concerns include the debate about whether rising inflation will be sustained enough to force the Fed to begin a sooner than expected rollback of its easy money policies. The Fed's main inflation measure posted its biggest annual increase since 1992, data showed on Friday. Now, this is quite relevant. We are now approaching the end of June and the beginning of July, so we're virtually halfway through the year. We've already seen equity markets perform well so far this year, again reaching multiple record highs. All that said, of course, there is going to be some concern because the last serious crash we had in equity markets was 2008. So we're looking at 13 years ago. And generally, you get a stock market crash on average every 7 years. So people are worried. Nevertheless, there's been such an enormous amount of money flowing into equities as a result of low interest rates, stimulus, people becoming more wealthy. We even mentioned in one of our recent videos that there has never been so many millionaires created than we have now, and that number is set to increase continually. And of course, once you start to enter that millionaire bracket, you then take on advisors who generally will advise that a proportion of your wealth goes into equities. But clearly as well, with the central banks buying government bonds, creating a favourable environment, and now politicians themselves coming out with major infrastructure spending plans and borrowing more money to do that, that will temporarily boost companies involved in those projects, thereby improving the various indices. However, what's perhaps going to start to affect that market is not so much the short term we will start talking about tapering, but when that tapering is actually programmed to begin. And that is where we may see, depending on how severe that tapering is going to be, then we may see some falls in equity markets. But until it's virtually guaranteed it's going to happen, then loose monetary policy is going to keep inflating this asset bubble. Let's carry on. As business rebounds from the coronavirus pandemic, the second quarter is also expected to mark the peak for US economic and corporate profit growth, which could bring market unease as growth slows. I'm totally convinced that this second quarter is going to give us the biggest growth, because there are still some laggards in the economy. But let's wait and see. Citigroup US Economic Surprise Index, which measures the degree to which data is beating or missing forecasts, stand at 26.5, well off last year's peak of 270.8, suggesting that the strength of the economic recovery is increasingly baked into estimates. Some investors also believe the S&P may be overdue for a significant pullback. Since World War II, the index has had a decline of at least 5%, an average of every 178 calendar days, according to Sam Stovall, Chief Investment Strategist at CFRA. The latest market advance has lasted 276 days without such a fall, the longest period since January 2018, when a 715-day advance was followed by a 10.8% drop for the S&P 500. Okay, but even if we get a 10.8% drop from current levels, that is, quite frankly, not as severe because of where the index will end up, as a drop back then was. There is not a lot of support beneath the surface, so that leaves the market maybe a little more vulnerable to a news headline or a news scare, said Willie Dalwish, an investment strategist with market research firm All Star Charts. Next week's focus will be on economic data, including reports on home prices, manufacturing, and Friday's closely watched US payrolls report for June. With inflation and the pace of the recovery on the minds of investors, a stronger than expected wage report could stoke worries over how the Fed will react. New York Fed President John Williams will speak on Monday after several appearances in the past week. To be sure, there are plenty of factors that suggest the backdrop for equities remains positive, and this, quite frankly, is our view at this precise moment in time. S&P 500 earnings are expected to rise by about 37% this year and almost 12% next year, according to Refinitiv IBES. In the second quarter, for which reports will flood in starting in mid-July, earnings are expected to jump 65%. Yields remain historically low, with the benchmark 10-year Treasury yield down to about 1.52% from 1.7% in mid-May, helping boost the allure of equities in comparison to other investments. And we'd agree with that. There's a lot of commentary about market crashes any day now, and the old adage sell in May and go away and then come back basically in September has not occurred as yet. And this is simply because of the flood of investment money is going into the markets. Still, only 47% of S&P 500 stocks stood above their 50-day moving averages as of Thursday's close, compared to 91% of stocks above that level when the index was making record highs in mid-April, according to Keith Lerner, Chief Market Strategist at Truist Advisory Services. The average stock in the benchmark was 8.9% off its 52-week high. If you're not in the few stocks that are doing well, you may be doing much worse than the benchmark index, Lerner said. And yes, and that is true. And as we've seen in the main markets, companies like Apple and Amazon have disproportionately, because of their size and capitalization, affected the market indices, so that when they do extraordinarily well, the markets naturally rise almost, not quite, but almost regardless of how the other stocks do. We must also not forget that at this moment in time, there has been a deviation of some reasonable levels of funding to the cryptocurrency market, which is standing at or around a capitalization of between 1.3 and at its peak $1.5 trillion. Now, some of these monies could and possibly would have been placed in gold and silver, and an element, of course, in the equity markets. What that level would be is very difficult to tell. But for those who for one moment say the levels of investment into cryptos have no bearing on levels invested into gold and silver, quite frankly, in our view, are deceiving themselves, which is often why so many articles are written naming Bitcoin as digital gold. Don't necessarily agree with that, but that is based on the foundation of the fact that many advisors are pretending, advocating, or promoting digital currencies, particularly cryptocurrencies, as an alternative to gold and silver investment. For those of us in this space, we hope they're not too successful. Otherwise, it would have a detrimental effect on the price of gold and silver. That's it. What do you think? Please share your thoughts below. If you liked the video, please give us a thumbs up. Subscribe if you haven't done so, and press the bell sign so you're notified of our videos as and when they are published. Thank you for listening. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.